While the SBA lending rates like CIT and GE Capital were folding up in 2008, there was a seed being planted, or should I say acorn. A guy named Chip Mahan received a bank charter in 2008 to open Live Oak Bank, a bank that would specialize in SBA loans to veterinarians. And 15 years later, they lead the industry with over $1.8 billion in 7A authorizations this past fiscal year. And that's almost double what CIT did in its best year. Our guest today, Mike McGinley, heads up small business banking for Live Oak Bank. He oversees 7A, conventional, and USDA. In our interview, Mike takes us behind the scenes of what makes Live Oak Live Oak. We talk about their credit philosophy, training closers from scratch, their impressive servicing department, the importance of in-person borrower visits, and more, including the inside scoop on their decision to go outside the theory of verticality, as Mike references it, into hiring generalist BDOs. So stay tuned. This is not one you're going to want to miss. The SBA industry is rooted in banking, and banking is old school, but that's all starting to change. You hear people talk about AI, and it all sounds great, but let's be real. You and I don't know the first thing about AI, but Lumos does. Lumos is an analytics company that provides small business lenders with better tools that drive better decisions in a more efficient process. Take the Lumos Business Report, for example. This is going to completely revolutionize how deals get underwritten, starting with the BDO. The Lumos Business Report allows lenders to search for a specific business and in seconds access all kinds of information like a business overview, industry data, insights into competition, average pricing, even a predicted expected loss, all tailored around that specific loan request. Guys, we can finally make credit decisions using actual data. Stop using what you think you know about an industry to make credit decisions and start using the whole story. Let Lumos take your small business lending to the next level with cutting-edge analytics and AI by going to lumosdata.com and scheduling your demo today. Mike McGinley, thanks for joining the podcast.
Thanks for having me.
So I'm excited to get to know you. What's your exact position? I want to make sure I get it right at Live Oak.
So head of small business banking. That's the title.
Mm-hmm. That's SBA, basically.
SBA, we do about 75% SBA. There's a little bit of conventional, a little bit of USDA thrown in there, but vast majority is SBA lending. Correct.
Okay, good. So I want to get into a lot of different things, but I want to start with your background before you got to the bank. Like, what's your background before that?
When I was out of college, my first job was as an associate business development officer. That's going back a ways now. But so my background's always been in commercial lending and SBA.
Okay. And you got to, I know at one point you were at PNC, right? Right before
Correct.
this.
Yep.
And you were a BDO there.
Mm-hmm.
And then I saw you switched over to closing manager, but that was around 2008. So I wanted to try to get the story there.
Yeah, there's a story there. So I was hired out of college, like I said, as an associate business development officer by Michelle Vervliet, who's currently at Customers Bank. Mm-hmm. So she was sort of my mentor. Yeah. And I worked under her for a while, learned the business, became a BDO. Come 2006, 2007, we start seeing, some blips on the radar in terms of the portfolio, like everybody else during that time. And we started to realize that the loans, when they would go bad, we didn't really have the right process for getting the guarantees, for documenting certain things the way that we would have liked. And so we had to do a little bit of changing of processes during that time. And so our national sales manager at the time, Pam Davis, asked me to build out those processes and essentially manage the closing team for a period of time.
So build out the closing processes to make sure you protected the guarantee during the closing, basically.
Exactly.
Okay.
Exactly.
How'd you like the closing stuff, by the way?
Looking back, I loved it. At the time, I was focused on building a book of business and being a lender, and I loved doing that. So at the time, I kind of looked at it as a chore. And, I was interacting a lot with our workout group and Herndon at the time. Looking back at it now, I'm so glad that I did it. I encourage a lot of our lenders now to either do a stint in closing or at least sit down with their closer and close some loans. I think it makes you much better at the front end of the process if you know the back end.
Yeah.
And so, at the time when you're in the thick of it, you're kind of looking around how to get out of it. But then looking back, I really appreciate the experience.
Was that sort of out of necessity? Had you guys pulled back on lending at the time? And
I think it was a little bit of just figuring out what we wanted to do at the time. I think we pulled back on lending as an organization, like most banks did at that time, trying to figure out how the portfolio was going to perform. And so it was kind of a good time to reflect a little bit on our process and make sure that we were doing things the right way. Yeah. So yeah, it was a little bit of pulling back on lending, a little bit of making sure that we revamped the process properly.
But did you want to like get back out there basically and get back
the whole
sales?
time. Yeah. And I did before I made any type of move. So once we kind of had that process nailed down, I started to pull away from closing a little bit and went back to being a BDO. At that time, it was still, we were kind of getting over the Great Recession, 2010, 2011, 2012. And so, we were still figuring out what we wanted to lend and how much we wanted to lend. And so that's why I took the opportunity.
Not that much.
Yeah.
Like most big, especially big, that's a pretty big bank, right? At the
exactly.
Time. So like,
exactly.
I know my friends that were at Wells at the time were basically not, it was like you're there, you're working, you're looking at deal after deal, but you're not actually doing any of them. Like,
that's exactly right. And we're people who want to help small businesses and get money out the door.
Right.
And so, your natural instinct is to want to lend. And
right.
Look, I get it. I mean, a lot of bigger institutions are going to be conservative at that period of time. And so, it's just two forces sort of
sure
going at one another.
I guess, did you apply for a position at Live Oak Bank at that time?
So I started talking to Live Oak, I guess this is mid 2012. And Steve Smits, who is currently our chief credit officer at Live Oak, was the sales manager at PNC when I was there. So we had a connection and we started chatting, and I didn't really think much of it at the time because everyone that they were hiring at that time was moving to North Carolina. And, I'm from New Jersey. I was living in Philly at the time. Like, I don't know if I want to move to North Carolina. I don't know anybody there. And so, I hesitated a little bit, and he said, just come down, check it out. No pressure. Come down on a Friday, come to our credit committee. If you like it, then we could talk. If not, then go home and, no worries.
So did they have a campus back then?
At that time, we just had a lease location down the street from where we are today. So okay. No campus at that point in time.
Okay. And it's for a closing manager position?
So yeah, at that time, Live Oak was growing and we didn't really have a centralized closing process. So we had closers working with various lenders, and they had good processes in place, but they didn't centralize closing. So everyone would do it a little bit differently. Mm-hmm. And so Steve asked me to come in and sort of do what I did at PNC and centralize closing. And, same reaction. Hey, I kind of just got done with closing. I'm back to being a BDO. Would love to do that. And he said, give me a year, revamp the process, pull everyone together and sort of centralize everything. And true to his word, about 9 months later, he was starting our investment advisory vertical, and then asked me to join that.
Oh, very cool. Interesting. So you got your foot in the door through the closing process. And by the way, so you went to a credit committee in the kind of interview process? Is that?
So it was more of, it wasn't even really interviews at that time. I guess it turned out to be an interview, but it was more of an exploratory, like, hey, get to know us. So I get there. I put my foot in the door, and 3 dogs came to me and pretty much jumped on me. And I was like, man, I love this place already.
That's how they get.
I'm a big dog guy.
That's their trick, probably.
Yeah. It's a good recruiting tool. And so, then they were just kind of walking me around and they said, "Hey, by the way, we've got our credit committee going. You should just come in and check it out." And, you know, if the dogs didn't sell me, then the collaboration in their credit committee kind of made me feel right at home. It was, just what I was looking for. The credit team, I thought the credit officer was the lender. And I was like, wait, okay, that's the credit officer and they're collaborating with the lender and they're both talking about the structure of the deal and why they like it and why they love the character of the customer and how they were going to win the deal. And I was like, man, this is impressive. This is a good culture and this is something that I want to be a part of.
Wow.
So by the time I left that day, I was like, well, I'll join if they'll take me. And so I joined a few weeks later.
Well, that's interesting because the credit committees I have been in were not so much fun. I haven't been in one in many years, but last time I worked for a bank, I would go in there and it would be kind of like, retired banker saying, why are we doing this deal? So like you're getting in there and they're talking like collaboration and it's like, what? So like how was that born? Like, how do you just create that sort of environment in a credit committee?
I mean, I think you hire the right leaders. So Chip Mahan, our CEO, is an excellent leader. He really instilled that culture of, we want credit officers and lenders to row in the same direction and do what's best for the bank and for the business, and not have the mentality of, the lender's trying to push the deal, the credit officer wants to say no at first. It's never a start with a no and convince me. It's a foundation built on trust, and it starts with a yes or a, I'm going to trust that this is a good deal. Now let's look at the facts and decide if it's the right structure. And so that was really just how the business was built. We also never really paid commissions to lenders. We still don't. And the theory behind that is, there's, if a lender is thinking about how they're going to feed their family, that's something that may unintentionally cloud their judgment, right? They may push for something just a little bit. I'm not saying they wouldn't be trustworthy. I'm just saying that little seed of doubt that the credit officer has that the lender's pushing a deal to get paid on it, just it's a little seed of doubt, right? And so I think that that was the foundation of it. It's a foundation of trust. And our credit officers to this day are pro deal. They want to make it work. And if the lender has built trust, then they're going to assume it's a deal that we want to do when it gets submitted to them.
The SBA landscape is changing right before our eyes, and technology is a big driver of that. To think, just a decade ago, I was getting physical loan packages mailed to the office. We've come a long way. But a lot of folks are still getting tripped up on emailing documents back and forth. Files are too big, there's security concerns, and my personal favorite, I already sent you that. Now, I don't have those issues because I use Able. Able is a deal acceleration platform focused on driving efficiency and improving the borrower experience. They plug right into your existing LOS and solves the document chaos between your team and your borrowers. Borrowers get a place where they can collaborate on loan documents at any time, and your team can easily name, organize, and push documents with the click of a button. Welcome to the future. I encourage you to go to able.ai for more information and schedule your demo today. So you liked what you heard, you liked the dogs, you joined the bank. So now you get in there, now you're in the job. You are being exposed to their way of doing business. Do you notice any big differences between the way you were basically being trained and how they were doing business versus kind of coming from a typical, big bank environment?
Yeah, I mean, they trained in a little bit of a different manner. So I love the way I was trained in my previous job, mostly because I had good mentorship and lenders that were teaching me everything. Live Oak does it a little bit differently in that you start off in servicing. So you don't get hired as a lender if you're, out of college or new to banking or to SBA lending. you start off in servicing. So you get the deal when the loan closes. You're calling on that customer for quarterly financials. You're learning how to do spreads. You're having those conversations when a problem arises or they need a loan modification. And so you're learning the business without being exposed to trying to, sell a customer or underwrite a loan day one. It's really good training, just a little bit different
That's
than the way I
genius,
came up.
by the way. Like, I've not heard anyone else do that, but that makes perfect sense.
Yeah. Most institutions, you ask for quarterly financials or for annual tax returns. Sometimes you get them, sometimes you don't. Some institutions are really good at collecting those. Some are a little bit more passive in collecting those.
Sure.
And we really took the stance that, as an SBA bank without conventional lending and without a ton of deposits, we needed to bat 1,000, right? You couldn't have a lot of deals go bad. And so we had our servicing group really get on customers for quarterly financials, and we're looking at trends. And because we had a vertical based model, you understand the industry. And so you see those red flags right away. If you see that a vet's revenue is ticking down, or the amount of clients that they're bringing in on a daily basis goes down a little bit, to start having those conversations to make sure that they're in a good position. And if there are any red flags that arise, then you address it quickly. Do they need help? We had a woman named Carol Hart, who's an ex veterinarian. And I use that as an example because that was our first vertical.
Right.
But we have a lot of examples of that. And she would fly down on our dime and sit down with customers for sometimes a week, going through their financials, going through their practice management software, and identifying any issues, coming up with suggestions on how to drive more revenue, reduce expenses. And, that led to a really low default rate.
Yeah.
And so you learn a lot as someone coming out of college and, understanding banking and how we do lending. And so, the training was a little bit different for me because I came in with experience and went,
Right.
Straight to a different position. But for most of the people that we bring up, you kind of work backwards through the process. So you start off in servicing, then you either go to closing or underwriting typically. And then once you've learned enough, then you could go to a lending team, and now you can speak intelligently about the entire process and set up underwriters for success because you're not putting through deals that aren't going to get approved.
When you put it that way, it's like, yeah, that makes perfect sense. But like, how many lenders are getting quarterly financials, actually getting them, and then actually reviewing them and actually assessing them and being proactive rather than reactive?
Yeah, it depends on the customer. I don't know what the exact percentage is, but it's the majority of our customers who are handing in quarterly financials.
Yeah.
I know our rate of getting annual tax returns is in the high 90s.
Wow.
And then quarterlies are lower than that. But,
That's
even if we
interesting.
just get an internal QuickBooks, at least we can see any potential red flags.
And the fact that you have the vertical model allows you to have a professional on staff who understands the industry, I guess, or like they're somewhat involved, and I don't know if they're full-time or just on retainer or whatever, but like you can't do that with you can't have 20 different people if you're a generalist lender. So some of these, it sounds like this is all intentional, like somebody actually thought about this. And
it's a little bit different than the traditional banking model, right? The traditional banking model is you set up a branch in a geography, you collect deposits, and you lend to the local businesses, and you understand what's going on in that market. But you also give up a little bit of industry knowledge because you're more focused on the geography, and typically you might have a certain niche or types of businesses you like to lend to, or a certain product. But we just took a different approach. Let's really understand the industry, and whether that's someone on staff who used to work in the industry, or a consultant, or someone that we just learned from, we wanted to have that expertise.
Good. So you come in, you're learning how they're doing business. You're charged with kind of reconfiguring the closing process, I guess, centralizing it, you said. How is the closing process at that time? Because you guys were doing probably like close to $500 million a year at the time in production, right? So you were already a really big shop. Was the closing process already pretty good?
Yeah, yeah. I mean, we always refine it and get better. But at the time, we were protecting the guarantee really well. We were good stewards of the program, and we had enough expertise between lenders who have been doing SBA lending for a long time, and then Steve Smits, who was head of Cap Access, coming in and helping out too. So the closing process was sound. It was just more about making it consistent.
And you said centralized, but like when you say centralized, like I think of physically centralized, but like am I thinking about that in the right way?
No, we had closers all across the country. Instead of being physically centralized, it was more about making them one team. So because we had a few different verticals at the time, they were really reporting up through those lending teams.
Gotcha.
And there was still separation of duties, and we had people checking what was done, and we had pre-funding reviews, but they weren't rolling up through one team.
That makes sense. Okay, so instead of going, keeping the departments of the different verticals separate, it was about closing was kind of one team, but then you had closers within the different verticals, essentially.
Yep.
So now I worked with a lot of closers in my day, and a lot of them, seems like the majority of them have been doing this a long time, like decades. So there's all these closers out here that have been doing this 20, 25, 30 years. Were you guys hiring from that pool of closers?
We did both. Some of the folks who we bring up through the process, and like I said, they may have started off in servicing. We would teach them, but we had a good portion of closers that we were hiring with, to your point, tens of years of experience in SBA lending. We felt we needed both. We wanted to make sure that we were bringing people up through, our training and, just bringing in new folks to the industry. So we wanted to do both, and it worked. You had experienced closers, and they would help teach the younger closers if they were new to the position. So it was a nice mix.
I know, and I'm gonna ask you more about like the culture later, but like culture, I have a feeling it's a big part of Live Oak Bank, and when you're bringing in brand new talent, you really get to mold them and bring them into that culture. But when you hire an experienced person who's been doing it 20 years, they have all these other ways to do it. So did you find it was harder to bring in experienced closers and then get them to kind of buy into what you were building?
Yes and no. So we that's always something that we have to think about when we're hiring. And because we're really focused on that, I mean, the resume is half of it. The rest of it is character. Are they someone that will fold into the culture really well? And when we have consensus calls after interviews with the people who interviewed potential candidates. We talk about that every time. Are they a cultural fit? Are they going to be people who, raise our flag and are good stewards of our brand?
Right.
And so we're very intentional about that even today.
I'm just curious, do you do the consensus call directly after the interview?
Yeah, usually same day or day after.
Okay.
It kind of depends on,
yeah,
the schedule and who is interviewing them and who's available for a call.
That sounds smart. I want to start doing that. You're dropping gold nuggets all over the place here, man. We're gonna have to clean this place up after pick up all these gold nuggets. So I'm gonna ask you a lot of like really complex questions, and I know it's gonna be really hard to give me answers, but like, how do you train closers from scratch? Like,
that's a really good question. And it's hard. Our closing team is amazing. We have, today we've actually got a closing trainer. So we have someone who is focused on doing that. And so before they get deployed to a team, they'll actually sit with our closing trainer. She teaches them everything she knows and, deploys her wisdom, and then actually starts closing loans with them. So we'll start bringing loans over to that team. She'll sit beside them, close loans with them. And then once they do a few and she says, okay, they're ready, then they get deployed to a team. So we really had a strong focus on that. And actually, the reason why we did that is because in 2021, with all the enhancements, all of a sudden we had all these loans in the pipeline, and we're like, oh no, we need to figure out how to close these. And our poor closers at the time had way too many deals, and they powered through it, and they're amazing. And so we hired up a lot at that point. And so we kind of said, okay, we just hired 10, 15 closers. How are we going to train them? And some of them had experience, and some of them, it was sort of a spectrum of experience at the time. And so that's when we decided to get a closing trainer who was really focused on that.
Yeah, that, I mean, when you get to a certain scale, like, you get these things that really help. Like, in most shops that are doing 150 million, you can't afford a full-time trainer, right? You have your closing manager that is doing the training and then doing the job, and everyone's got to wear multiple hats and do multiple things.
And we did that for a long time. And then we realized our closing team managers, between problem solving and getting a deal across the finish line, doing pre-funding reviews, like, they don't have time to really sit there and focus on training. And so you're right. I mean, with scale comes the ability to do a little bit more. But we needed to free up our closing team managers to do what they do best and drive deals across the finish line.
Makes sense. I think after you got there, because, when I do my research, I do my deep dives into the stats and to the numbers, and you became the number one lender after you got there, right? It was because it was Wells Fargo for a while, then you guys. Now, does that mean anything to you guys when you hit, when you get to the number one spot? Like, do you like make a cake, or like how's it work?
No, I mean, it definitely means something. I'd be lying if I said it didn't. We celebrate for 30 seconds and we get back to work, and just do what we do. We never really, I don't think that was ever a goal necessarily. It was, grow and build new verticals, and just continue to put out good loans and do the best we can for our investors and everything. But it was never the goal to necessarily become the number one SBA lender, at least not from what I remember.
Well, Live Oak has now the record for 7A volume in a year, right? This year you guys just shattered your own record. And if I would ask Chip, you took this uncharted path to get here, which was the harder path. You could have, why didn't you just take the CIT model and scale up to 100 BDOs and do it that way? Like, why take this other path over here that was so different and so much harder? What do you think he would say?
I never would speak for Chip, because I have no idea what he would say. But if I had to guess, I think he'd say that, he really wanted to put on high quality credits, and he really felt that the way to do that is with the industry expertise and what he calls the theory of verticality. And then, eventually, and you may get to this, but we do have a BDO model as well. And so we started adding lenders in that arena, and really kind of thought of that as a vertical as well, right? So in all of our industries, we have an expertise, and we realized, man, there's some lenders who at this point we had brand recognition. Mm-hmm. And so we had lenders who would love working with us. And we kind of said, well, let's bring them in. And these are acquisition experts. These are people who have been doing this for 15, 20 years and know how to do a change of ownership and a transition deal. And so we almost thought of that as a different type of expertise, but one that, could help grow the business. But kind of circling back to your original question, I don't know exactly how Chip would answer that. I mean, I think when you start a vertical, you can scale that pretty quickly if you pick the right vertical. So, you cherry pick industries that are really strong in terms of credit quality, and you can explore that in a number of different ways. And then you couple that with a scalable industry. And what I mean by that is there's industry associations, there's trade shows, there's COIs, there's brokers, there's investment bankers who work in these communities. And, you could start a vertical, get a commercial lender, pair them up with someone from the industry. You build a structure and a product that's both SBA compliant and works for the industry. And you start to become a thought leader in that industry. You start to speak at conferences, and you say, an example. So when we started the investment advisory vertical, which was a lot of wealth managers, independent wealth managers like RIAs changing hands and acquiring, and they would essentially do earnouts, and only earnouts. And sellers would get 20-30% down, and then they would take on the risk ongoing. And we said, hey, there's a better way to do this. And we would start to speak at conferences and do workshops and educate the industry on how we can structure these loans. I remember my first conference when I was at Live Oak. We had a booth set up at one of the large wealth management conferences, and they said, oh, you want to give checking accounts to my clients? And we said, no, we want to give you money to go acquire the next business. And I saw eyes start to light up, and you can scale that up pretty quickly and put really good quality loans on the books. So I think that's how Chip might answer that is scalability, and you know what you're putting on your books, and you know that they're strong deals.
Well, so it sounds like the whole vertical model was really important to the success of Live Oak Bank. I think what I see a lot of is marketing to verticals. It sounds like you had more depth to the model. Like, what do you think the big difference is? Like what you guys were doing versus me just saying, I'm going to now go do self-storage deals and just put a flyer together that says, I have a self-storage program, right? Like, what's the difference?
I think taking the approach, one, you build partnerships with people who are influential in the industry. And then two, solving problems. So if we know that there's something missing in that vertical, like what I described in wealth management, or in healthcare or dentistry, we do a lot of ground up construction for either expansion or startup, or so we kind of find these areas where there's something missing in the industry and try to solve a problem. And so
interesting.
Once you have something that you're solving, then all of a sudden speaking engagements open up, and leaders in those industries are open to having conversations and making introductions. And so I think that's what made us successful, at least in my experience. Every industry is a little bit different, and I'm sure if you asked vertical heads in other industries at Live Oak, they may give you a little bit of a different answer, but that would be my take on it.
So you're kind of like looking for untapped markets.
Yeah. Niches within industries, problems to solve, that type of thing.
So you have all this success going vertical. You make the vertical model famous in SBA. Everyone's trying to kind of copy it. But then you make the decision to hire generalists. However, I understand what you're saying. They're acquisition specialists, but they're also doing some real estate and partner buyout.
Mm-hmm.
And that basically represents 75% of SBA lending. So generalist. So is that a tough decision that you have to make at that point to say, hey, this is a little bit of a pivot right now that we're doing?
There was definitely some internal healthy debate on whether or not we would go that route. We talked all the time about that's why our credit quality was so strong, is that we really knew these industries and we could identify the red flags. And so I think there was a little bit of worry that we were stretching a little bit too far with that. But we kind of sat back and said, and this is more Chip than anyone else, said, look, there's really good lenders out there who want to be a part of what we're building. Why would we deny that? Why would we say no to someone who has a ton of experience, has a good track record, would fit well into our culture? And I think, he was sort of the visionary there and said, we need to step into this and hire some folks. And so I think we took the approach of, well, let's hire a few, see how it works out, and go from there.
How many do you have now? Do you know? Not to put you on the spot,
38.
It's a lot. So how do you think it was the right decision?
Yeah. Yeah. We have a lot of good people. That team is awesome. Some people I'm sure you probably know, but
I know, yeah.
that team is really talented, and they've done a great job.
Yeah. if that's an acquisition vertical, is there an acquisition expert that you guys talk to or have on retainer, kind of like the veterinarian situation?
No, that's a little bit different. We just, when we're building out verticals, a lot of times you'll have an experienced commercial lender. You're pairing that with that expert, and then you usually have, a couple of loan officers who may have just come from underwriting, a little bit younger. You're kind of bringing them up. With the generalist team, it's a little bit different because they have a ton of experience.
Right.
So they, in their own right, are the
That
experts.
makes sense.
Yeah.
Okay. So now, you're scaling to, 1.7, I don't know, I'm losing count, billion, but how do you maintain that customer service on that big of a scale? Like that consistent customer service?
We hire good people. We make sure that we're building out capacity. So we're not going to hire lenders without hiring underwriters, closers, credit folks, servicers. So we just continue to hire the right people. And I'd also say we have an incredible leadership team. And so they're laser focused on making sure that we make those right hires. And they're looking at the pipeline data to make sure if there's a tick up in the pipeline that we've got enough people on the back end. And so it's just the leadership team.
Yeah, and you guys probably have some crazy data on units and like figuring out how much underwriting capacity you need and closing and stuff like that. Some of these people out there in SBA nerdland will probably be like loving that type of information. Is that something, I'm just speculating, but do you guys like have those type of numbers, like data that you look at to figure out?
Yeah. We have dashboards, we call them insights dashboards. Actually, when, Brett and that team were at the bank, they really built it out. And, we've also got, we have an underwriting manager and a closing manager who are amazing. And they look at data all the time to make sure that they have the right number of FTEs. And if they look at the pipeline and they see an uptick, or we're hiring lenders and they can see that volume coming, they'll raise their hand and say, hey, I need someone. And so it's a mix of having really strong data and digestible data, right? You can have all the data, but if you don't have a way of putting that into something that's actionable, then you can't really do anything with it. So it's a mix of that, and then having really strong managers who aren't going to put their team in a position where we're not going to have the capacity to do those loans.
Yeah, that makes sense. And that's, I mean, a lot. You're on a different level because of just the sheer scale at which you're doing it. Because I just know that the shops that are in that 150 to 50 range, let's say on the top most active lenders, like you're not turning enough units to have data. And it's like the data, it's like if you're closing only 10 loans a month, that's just hard to get that data. So you're kind of just winging it.
Yeah.
You guys can look at a dashboard and figure out, oh, we need to hire 2 closers.
Yeah, you have to make the investment, and it's not easy, right? I mean, there's a lot of work that's done to take that data and make sure it's accurate.
Right.
You've got to clean it. And then you've got to be able to put it into something, again, that you can report on and is actionable. But yeah, you're exactly right. I mean, we have the ability to do that because of our scalability.
Not to put you on the spot, what else, like what other like benefits of being, this large do you think you have over other like shops?
Man, that's a good question. I think that, when you're that large and you've got a lot of experience, a lot of times, when we're hiring experienced lenders, they may raise their hand and say, hey, how come you do it this way? Like, what about this? Right.
Mm-hmm.
Or at my old shop, we did this differently. And so, by having scale, you also have a little bit of a think tank. And we've really built our culture as horizontal as possible. And, if we hire a lender and they notice something and they email, our president BJ or our CEO Chip, they'll schedule a meeting with them like the next day. Like, let's go have lunch and talk about it. And so having that ability to have your ideas heard and have upper management pay attention to what you're saying, and they sit there and listen, and then they ask more questions, and then they'll say, well, maybe we should implement that. And then if we want to implement it, we make sure it happens. I think that's something that has really helped us out over the years. And, hiring people with experience has really led to getting better and better over time.
Yeah, no, that makes perfect sense. So I want to really understand the secret sauce here. So we're going to play a game.
Okay.
So I'm trying to think of the problems that the folks at home, that are building their SBA departments, the problems that they would have as they're trying to scale. And it's like sort of like I don't want to say excuses, but it's the reason, we can't get to 300 million and 500 million and whatever in production and beyond. And then I want you to tell me kind of like what your philosophy would kind of be on this problem. So the first one is sort of like the capital investments. Like we can't invest, it's in this technology and whatever other sort of capital expenditures there are because of the short-term profits, right? So what would you say to that?
I think there's a way to make small investments over time, and you don't have to boil the ocean in a day. I think if you make small movements and, put together a strat plan that says, this year we're going to focus on improving data. You'll probably need an FTE for that. And depending on whether or not that's, okay in terms of the budget and what the institution will allow, you've got to make that investment, but you have to start somewhere, right? So I think if you pick something that you want to improve upon, pick one little thing, do that, implement it, and then build from there.
Okay.
I think a lot of people, and this is just my experience in other places and from what I've seen, sometimes there's a little bit of paralysis by analysis, right? You start to think about all the things that you want to do instead of focusing on one thing to improve the business.
Sure. No, that's good advice. What about not enough talent out there? We can't scale. There's just not any good people.
Teach them.
Teach them.
I mean, hiring someone out of college that is talented, and they've got, a thirst for knowledge and to learn and to provide value. You could do a lot with that. And so, whether it's someone right out of school or someone that's trying to change careers, there's a wealth of knowledge in this industry. Think about how many people have been doing SBA lending for, many years. There's a lot of knowledge that can be transferred. So transfer it.
Do you think they have to then go into an office, or like if
Yes.
you do that, they're going to Wilmington office, right? They're going to
Yes, I believe you have to.
Yeah.
It's different if you hire someone with experience, right?
Right.
They can set up a home office. They've probably done it before. It's fine. Hiring someone, especially if you want to have a laser focus on your culture, they need to be in the room together, and they need to. It's a lot harder to get up the courage to call someone 5 times a day if you have questions, because you're like, man, I'm bothering them again. I'm going to call them. But if you can just walk down and say, hey, I've got a question, it's so much easier. It's so much quicker. There's no, voicemail call back, or, you try and Teams them or, Skype them, and, then they're not available. They're on a call. Just walk down and say, hey, I've got a question. So I think if you're teaching someone the business, it's in my opinion, it's a deal breaker. They've got to be in person.
Are the Wilmington folks going into the office every day, or are they more of a hybrid model?
We went back to the office in September. 5 days a week, you're in the office if you're in Wilmington.
That's a big debate we're constantly having in the world, because, I like the office, but I also don't want to leave my home. So how do I make
it was a tough decision, and there's arguments for both sides of it, and some of which were, do we really want to lose people because we're not allowing them to work at home?
Right, because people want that now.
I think 3 people decided not to come back.
Well, it's a small number for
still some of it is, we've got a great campus, we've got a restaurant, a fit park, like it's not a tough office to go to. So there's that, but at the same time, I think people missed the collaboration. And so
I get that.
the example I gave before of, management wanting to hear from people and make improvements to the business and get their opinion on credits and where we're going. And, you know, I think we were missing a little bit of that. And I think the collaboration not only leads to efficiency, but I think people are generally happier.
Interesting. Okay. What about profitability? You know, salaries that are all-time high, I feel like, in our industry. BDO comps, big, brokers, fees, like we can't even run a profitable program. How are we going to scale?
Yeah, that's difficult. Our model is a little bit different for lenders. So we focus a little bit more on equity than commission and cash. So we lose some recruits that way. But we feel it's important to our culture and the way that we do things. We want people to be owners in the business. So we're going to focus on LTI and long-term investment. Hopefully that leads to building wealth over time versus cash incentive, which depending on the program can be more of a short-term incentive. So with lenders, it's a little bit different. It's just a different model than what most are used to. Everyone else, yeah, I mean, we had to pay up a little bit. I mean, I think it's not only our industry, but other industries as well that, you know, salaries were on the rise and you have to pay people.
Yeah. You know, I feel like another point that people, like a shop gets to a capacity when the chief credit officer gets to capacity, because the whole shop's built around this one person, and they're always the hardest working person in the organization where I've been. But then how do you go beyond that?
You have to have a strong team around the chief credit officer. And, you know, Steve Smith's our chief credit officer, built a great team. I mean, we've got a lot of great credit officers with a ton of experience. Some of them were lenders that, you know, learned from other lenders in the bank and, you know, may have come up through underwriting and then were lenders for a period of time and then wanted to move over to credit, because our credit team doesn't have that, like, oh, those are the credit guys, you know, they're introverts and, you know, they sit there and want to say no. Our credit team's part of the deal, and we bring them on site visits. And so it's a little bit more of a position that it's palatable and people want to be a part of it. And so I think that was the key for us, is talented people wanted to be on the credit team. And so
they made it seem kind of cool.
Yeah, absolutely.
But Steve's not looking at every deal.
No.
So they have credit. You scale through having other trusted credit managers that have approval authority.
That's correct.
Okay.
And they collaborate really well together too. So if there's a deal that maybe isn't right down the center of the fairway, they may talk to Steve or talk to Michael Carnes, who's our head of credit, and you know, they'll all collaborate and come to a decision. And the lender and underwriter are a big part of that conversation as well.
Last one, I think the biggest one right now, and I'm seeing shops fall by the wayside right now because of credit quality or an uptick in defaults. I'm going to give you an easy question. How do you scale to $1 billion plus and keep defaults low?
I think it's really partially the same answer that I just gave, is having a really talented credit team. And I think you need to have lenders and a credit team and underwriters, for that matter, that are rowing in the same direction and have the same philosophy on credits and want to put good loans on the books.
But there's something in there that's interesting, because the credit philosophies I've heard in the market are, and this is from BDO, so take it with a grain of salt, and I say that as a BDO, but we do any deal that makes sense. That's one I've heard in the market. We do any deal that cash flows. We underwrite to the SOP. And then on the flip side, I've heard credit people saying, I don't like car washes or whatever. Like, I don't like gas stations. Like, what's your approach seems a little bit more methodical, maybe, in a way. Like, is it more data driven? Like, what's this? Just give me the secret sauce.
It's actually the opposite. It's not more data driven, though data helps. it's looking into the character of the small business owner. So we talk about this all the time, is do they have the eye of the tiger? When you go and sit down with them, if things get tough, are they going to show up? And that's more of a feeling and commentary than something you can put in quantitative data. And so that's something that we've always talked about since I've been at Live Oak, is do they have the eye of the tiger? If things get tough, are they going to fold and give you the keys, or are they going to grind it out? And
right.
I think if you couple that with a servicing team and a special assets team that thinks about rehabilitation rather than foreclosure, I think that's a recipe for some wins. I also think we're really good at pivoting. So in our verticals and even our generalist team, if we see some deals that are having a little bit of trouble in servicing, or we notice any trends, we fix it right away. Okay, this industry is going through a little bit of trouble and margins are compressing. Let's up the coverage ratio a little bit, or let's adjust how we're thinking about equity in. And so we're really good at pivoting, and because we have really good collaboration with our credit partners, we talk a lot about that type of stuff. So we have a charge-off meeting every quarter where we review every single loan that's been charged off and talk about why and what we learned. And it's not a witch hunt to say, lender and credit officer, why'd you approve this deal? I don't think that's ever been asked. I think it's, okay, what are we learning from this? And Roger Stockton, one of our senior credit folks, will actually put together a key takeaway list from all those meetings, and talk about any trends that we discussed or that we're seeing. And then we also have a watch list meeting every quarter for every single vertical. And so before deals go delinquent or go on non-accrual, if they either missed a payment, or even before they miss a payment, if they've called us and said, hey, I've got a problem, they immediately go on the watch list and we start talking about them.
Interesting.
So I think getting in front of those credits really early has been really important for us and a key to success.
Dude, I can't wait to watch this episode, play it back. This has been so insightful. Thank you so much. I think we're gonna wrap it up. I think I have one last question.
Yeah.
And we kind of touched on it a little bit, but I've heard a lot of just good things about the overall culture at the bank, at Live Oak Bank. How important do you think that culture is to driving the success of the bank?
It's the most important.
Really?
Yeah. We talk about that as a leadership team every day, week, meeting. How do we sustain the culture? How do we continue to emanate that culture in the community? Community's been a big part of that. If you go pretty much anywhere in Wilmington, North Carolina on any given day, you'll see a group of Live Oakers with a Live Oak Volunteer t-shirt, cleaning up garbage on the side of the road, or packing meals for various charities, or walking service dogs around the bank to get them acclimated with people. And so having a sense of community and charity has been a big part of our culture. And so, yeah, I mean, we talk about that all the time. It's embedded in our hiring process. It's embedded in, when we talk about our strategic plan and where we're going. I think that actually comes up before we start thinking about profit and loss. So if we're going to do something and we feel like that may put our culture in danger, or, even be a blip on the radar there, we reconsider.
Right. That's a really great answer. And this has been, like I said, one of the most insightful interviews we've done. So thank you so much. I'd love to end it there, but I just have to ask you one other question. Do you still meet every borrower in person?
Just about.
You talk about character.
Yeah, we try to meet every single borrower we can in person. Obviously, through COVID, that became a little bit more difficult, and we required more Zoom calls than in person, and that worked out just fine. But yeah, we expect to meet just about every customer in person, especially of a certain size, if it's a certain exposure.
Large. Yep.
And we want to sit down with them. We try to meet sellers and buyers together if it's a change of ownership, if they'll allow it. Some you can't do that because they're not ready to tell their employees yet, but that could be a red flag. We start to think about, what does that transition look like, and are the seller and buyer getting along, and how are they thinking about their transition plan? All that comes into play. So whenever we can, we try to meet them in person. And honestly, it's a great sales tool because a lot of times their deposit relationship is right down the street. I've been on site visits where the borrower says, well, where'd you come from? I said, Wilmington, North Carolina. And this could be in Sacramento, California. They're like, wait a minute. Well, why are you in town? To see you. And they go, you came all the way across the country to see me? You say, yeah, that's why we're here. We want to learn about your business and learn about your story. And we want to help you get capital. And they're like, in the same parking lot is my branch, and they've never been in my office before. And if that's not a powerful way to win a deal, I don't know what is.
Amazing, dude. That's awesome.
Yeah.
All right. Well, thank you. And we'll have to do a part 2 to unpack that whole last part. I mean, we could go another hour, but we'll end it there. Thank you so much.
Well, I appreciate you having me. It's been fun.
Awesome.
All right, that's it for this week. Don't forget to subscribe to the podcast so you never miss an episode of the Art of SBA Lending. And if you have any feedback or suggestions, email me at ray@artofsba.com. Until next time, ta-ta.